There's services inflation, like the cost of experiences and going out and food and restaurants and gas and all those things. Well, that stuff has been coming down as well. In fact, even in some of these jobs reports, we've been seeing job openings come down for leisure and hospitality.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. It is Monday at 10 p.m. on the West Coast after midnight, July 9th on the East Coast. Happy heavenly birthday to my dad, who had been 82 today. And I mentioned on my last video that the Biden administration signed a bill, the National Plan to End Parkinson's Act. So there's more money allocated. My dad died of complications of Parkinson's about 3.5 years ago. And I am taking my family to Ranger vs. Angels game tomorrow night. He's taking me to a bunch of games. So on that note, I saw online on a credible news source that there is a well-known Parkinson's doctor that has been on the White House visitation log this year, like 12 times. So my hope is that that's not the case. It's a very tough disease for anyone to deal with, especially, President Biden has got a high-pressure job. I know maybe in high-pressure debates, maybe he isn't, performing under the mic, but I remember my dad, as he aged towards the end, he still had good thoughts and just a little slower to get it out, but his brain was very sharp. There were signs of dementia towards the very end, but anyway, I've had experience with it, and I think in a closed door, when Biden's alert, I mean, he's experienced executive, so it's an endorsement on him, or it's not a knock on him. I'm just kind of wrapping my experience with Parkinson's in case that's the case with him. So God bless him and his family if that is what they're dealing with. I'm going to beat up the jobs report here in just a second and then get into the inflation report. And but before that, I have two podcasts this week. So on the big picture with Rob and Robbie, which is always awesome. We've got a great podcast coming up. That's Thursday, so I think that's typically noon. That would be noon on Thursday. That's every Thursday if you don't watch that one. It's kind of there's a lineup of shows that are an extension of the Crispin blog, which is a fantastic place for all of your updates and news. I hope every one of you read it. It's an absolute must. Crispin blog, but should be a good one this week. And Brian View and myself are on it, I believe, and we are plugging our podcast that starts on Friday. It's the last word. So that's on Friday, I guess, because it's on Friday we get the last word. There's a joke around here with Gary Malice, my partner. We always like to say, like, he and I jockey for the last word in all of our ownership discussions here. So anyway, that's on Friday, 10 a.m. Pacific and 1 Eastern. So we're going to try and end the week with some information for everybody. Sorry. It was dusty in my office, so I take a little sip of water here. So, two podcasts coming up. Speaking of Gary Malice, he was on an advisory board for Compass Analytics, which was, I believe, purchased by Black Knight several years ago. And one of their founders, the co-founder, Rob Kessel, brilliant mind, MIT grad. He took some time off. He was sailing around the world after he sold his company, and now he's back in action. So he's got an education advisory firm, which I thought was pretty freaking cool. If you go to LinkedIn, you can see my partner, Gary Malice, had a nice plug for Rob. So Rob Kessel back in action with Panoramic Capital Academy. So I figure I'd give them a little love. Okay, let me get into the jobs report. Now, I mentioned this last week. The dot plot by the Fed members, remember, every other meeting, they put their summary of economic projections, the SEP, the dot plot. They have the unemployment rate at 4.1% at the end of the year. We have it in June. And there are a couple on that dot plot who say 4.2%. But the unemployment rate is rising. Jobless claims are steadily above 1.8 million. So there is softening in the labor market. But, one of the modeling things that the Fed has always done is they always looked at wage inflation. And that's been coming down, right? Remember, I've talked about for 4.5 years now, the wage price spiral. Wages go up, which cause people to chase fewer goods, and then those prices go up, and it's just this endless spiral. Well, the supply chain got fixed after COVID, and goods inflation isn't really the big thing. There's services inflation, like the cost of experiences and going out and food and restaurants and gas and all those things. Well, that stuff has been coming down as well. In fact, even in some of these jobs reports, we've been seeing job openings come down for leisure and hospitality. This jobs report only had a 0.3% month over month increase in wage inflation, which annualized out to a 3.9%. So that's a three handle, 3.9% instead of 4.1, a four handle, just the month prior. So these are numbers that we have not seen since May 21. So long before we had 5.25 to 5.5 Fed funds rate that are sufficiently restrictive, we're not seeing wage inflation creeping up. That's a big deal. Hat tip to the MBS Highway crew. I just got caught up on some videos with them. There's been a lot of revisions to the Bureau of Labor Statistics jobs reports. And one of them that I found extremely interesting, not the headline number, because the headline number, obviously, like 110,000 jobs were pulled off the headline number from April and May. So our June beat of like 206,000 or whatever the number was reduced down by almost like 111,000 jobs. So like you netted out under 100,000 jobs gained. And it's crazy because like when there's a beat in jobs and the market's like, oh, the economy's roaring, but the next month, like, oh, just kidding. Our 3-month average is 177,000 jobs created. I got that from Mike Fratantoni, chief economist over there at the MBA. So jobs and labor is weakening. But here's something the MBS Highway crew put out that I thought was extremely interesting. Full-time versus part-time jobs. They stripped this data out. This is very interesting. So in June, full-time jobs went down by 28,000. 28,000 less full-time jobs. Okay? There were 50,000 more part-time jobs. Now, I believe this is in the household survey. Q2, the entire quarter, okay, April, May, and June, 296,000 full-time jobs wiped out. Net. 336,000 part-time jobs were increased. So when you go less full-time jobs and more part-time jobs, and the labor force is growing and unemployment rate is going up, those are not good signs. So labor is what the Fed is going to be focused on rate cut watch, a parlor game that we all love playing. And just for everyone who's watching this, these things move slowly. Because we talk about it every day doesn't mean they're going to cut. They need to wait. And they're going to wait for the CPI. And they're going to wait for inflation to come down and continue to come down. And there are some lag effects. The CPI, Consumer Price Index, a huge number coming out on Thursday. It's like 45% of it is housing. Owner's equivalent rent, shelter, lodging away from home, shelter, roof over your head, all that kind of stuff. This is an index, right? So 12 months ago number gets replaced by this number. And so there's this lag of these numbers that were going up, but then they start going up slower and slower. And for it to be a full 12 months to be at a lower rate, we see where it's going. We know it's going down the path to get closer to 2%, which the Fed says you don't have to get to 2%. Remember, their preferred measure of gauge of inflation is Core PCE, personal consumption expenditure. The 40-year average is 2.4%. 40 years, it's been at 2.4%. It's not going to 2 before they start cutting. And they've even said they don't expect inflation to get around 2 all the way through the end of next year, 2025. They're going to cut when labor breaks and gets to a point to where they feel like they got to clear the deck and start reflating the liquidity of our economy. Remember, their balance sheet has come down by like $2 trillion, right? That's a lot. And the economy has been growing since pre-COVID from something like $19 trillion GDP to like 20. I've seen some numbers estimate like 27, but I think I said the other day it was like 4 trillion. That's a huge growing economy. I mean, it's a massive, massive economy. that's out there. Okay, so inflation, okay, CPI estimate is 0.3% on the core month over month, 7 months in a row. So the estimate going into this reading has been 0.3. The estimate is finally something different. It's lower. It's 0.21%. So that is proof that there is acknowledgement by institutional traders and bond traders and everyone making all these estimates on data that inflation has come down. The estimate is no longer at 0.3% for a month over month increase. It's only 0.21%. So you guys know that I spend money on a tremendous amount of stock subscription services. I am not responsible for your losses, only your profits, but I'm about to give you a little stock tip here. If you're still with, hang on just a sec. So Tom Lee from Fundstrat, great advisor, analyst, and he broke down all the CPI reports and how they impact the stock market, which I think is interesting. So we'll just take the last 7. The stocks rallied all 3 times the CPI beat the estimate. So he thinks that, if we're at 0.24, 0.25, we're lower, that the stock market will rally on Thursday. That's just what he thinks. Now, 2 of the 4 times when inflation came in higher than the estimate, that 0.3 estimate in the last 7 months, still rallied. So only 2 times in the last 7 months did the stock market not rally after the CPI came out. Thought that was interesting. And the expectations for 2 Fed rate cuts shot up a few times just in the last, let's call it month and a half. The big one was after the May CPI. Remember when we had January, February, March, the readings that came out for February, March, and April were a little bit hotter, a little bit higher than expected. And that inflation caused everyone to go, oh, we're not cutting up to 6 times or 3 times like the Fed said they were going to back in December. We got to take a pause. Well, now we've worked that little 3-month, inflection of inflation out of the system and out of the expectations. And here's what happened. Big one was when April PCE, the Fed deflator, came out. The expectation, which you can go to the CME tool and see the Fed funds future rate and see what the expectations are for rate cuts, shot up to 2. There's been little ups and downs. That expectation, it shot up again when the May CPI came out and the May PCE came out. And then, of course, when the June jobs came out last week. And so if we have a lower inflation number here, CPI and PPI this week, and the Fed speaking this week, we have Fed auctions this week, do we see that number go up? Do we see the 10-year Treasury make its way down to that next little resistance, that little support at 4.2, right? We've gotten as low as like 3.89, but that was back when the Fed was saying, hey, we're going to cut 3 times this year. Well, now we went to 1, now we're 2-ish, 2-ish. It's going to happen in September. Who knows? We'll see all that. Okay, so let me just talk a little bit about bonds. Okay, the dollar's weakening a little bit. The yen is at its lowest point in like something like 20 years plus. So, there are federal banks around the world that are cutting their rates. We have not cut our rates. The dollar is weakening because our economy is weakening with GDP and unemployment numbers coming out soft. And so the dollar getting weaker is actually good for stocks that have international exposure, like, for example, Apple or Google or anyone that sells things. Tesla, by the way, anything that sells things around the world where the dollar is so strong, now those foreign currencies are gaining strength against our dollar. By the way, Tesla just rallied for like the 7th trading day in a row, which is crazy. Ninth trading day in a row. A little nugget I saw there. The TSA screened over 3 million people yesterday. First time ever. One day, the TSA on airports, big travel day. Investors are flocking to bonds. TLT, look that ticker up, the TLT fund. It's a treasury fund. Remember, when yields go up, the price of bonds go down. And when yields come down, especially after a Fed rate cut, the price of those bonds go up. And so people are buying TLT. I'm a full disclosure, I'm an owner, big fan, been winning there. And Paramount Global is Saks and Amazon are buying Neiman Marcus, and then Paramount Global has got a deal that it's cutting there as well. So lots of M&A activity, lots of stuff going on. Credit card spending on the rise. Consumer debt and borrowing is going up. It's going to be an exciting week. Have a wonderful week after July 4th. Hope everyone had it safe this week. Cheers. KP coming to you live from Corona, California. I have some really exciting news, and I normally don't get this excited because I just look at data and I read it and I just try and bring it through my little brain here, my prism. But did you know that a mere 48 light years away, we have discovered an exoplanet revolving around a red dwarf star that has liquid water? It even has a nitrogen atmosphere. Pretty cool, right? It's all 1.7 times the size of Earth. Liquid water is about 68 degrees Fahrenheit, 20 degrees Celsius. It's a temperate climate zone for those that have seen Monty Python's Holy Grail. And this planet, when it rotates around this red dwarf sun, if you will, star, it's 20% the size of our sun, but still gives off heat. It doesn't rotate. It's the same side of LHS 1140b, the name of this exoplanet. The same side stares at this red dwarf star. So that has like a little ocean on it. So anyway, back here on Earth, 48 light years away, inflation's coming down. We actually have deflation. The CPI report, the Consumer Price Index, which is not the Fed's preferred gauge of inflation, the Fed deflator, also known as the PCE, Personal Consumption Expenditure. The CPI came out this morning. PPI, Producer Price Index, is tomorrow, and it was deflationary. So there's inflation, there's disinflation, which is, we still have inflation, it's just growing at a slower pace, and then there's deflation, outright deflation with a negative 0.1% read on the headline number. So food and energy help bring down the overall number, but if you strip those out, you have what's called the core number, and core CPI only went up about 0.64%, right? So if you multiply that by 12, which is a stretch, I know, you're at like 0.8% for the year. So not a big number of inflation. So it's deflation on the headline number with a negative 0.1 read. Disinflation with only a 0.1% increase in inflation for the core CPI. Owner's equivalent rent, is a part of shelter. It's come down quite a bit. Zelman Research, they do a great job. They're now a Walker and Dunlap company. I subscribe to the research. Would love for you to join them and check them out. They've been modeling out owner's equivalent rent, and they got this down pretty good. And this number is about as low as it's been since like May of 2021. Now, the last time the headline CPI number, the entire number, had a deflationary read was June of 2020, negative 0.8%. Remember, we were getting our first real report in the pandemic where the entire, economy shut down, everything shut down, nothing was working, no one was working. And so it's been that long since we've had outright deflation. So let me read some comments that the Fed said in their testimony. Chair Powell at the Senate Banking Committee, that he said before this read came out, he basically said that the most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably towards 2%. At the same time, in light of the progress made, both in lowering inflation and in cooling the labor market over the past years, elevated inflation is not the only risk we face. Again, they're looking at labor. That's a bigger risk. Now, is this an anomaly? Will the next 2 inflation reports and 3 jobs reports before the September meeting, or 2 jobs and 3 inflation reports before the September Fed meeting, which is the next time they have the dot plot, will they be higher? We had this little spike, in January, February, and March in inflation. I would say partly due to the December dot plot by the Fed, where they got excited, said there would be 3 rate cuts this year. Stock market started ripping, money started going all over the place. People started spending, euphoria, buying this, that, and the other. And maybe that led to some inflation. But now that the market has had a chance to cool off since that dot plot in December, this reaction to this reading was the second largest single day improvement in mortgage rates all year. So it was a good reaction from the mortgage world. The 10-year Treasury yield came down. It touched as low as 416, 417, if you will, but then closed above 420, which has been kind of a level it hasn't gone below. Even the 2-year Treasury has gone down and touched down at 4.5% range and then closed a little bit higher. And so if the PPI has some follow through tomorrow with lower than expected inflation numbers, seeing this energy number being as low as it is, you might see a beat. Although we know that oil prices have been going up recently. So does that give us a surprise? The upside in PPI. But if there is a downside surprise and there's a beat on inflation for PPI, you might see the 10 and 2-year yields on the treasuries come down even further and actually close at the end of tomorrow's market at the numbers that they touched the lows for the day, but then came back up and closed a little higher. So it's just a technical thing to look at the charts. Speaking of charts, gotta love the MBS Highway crew. Barry and Dan did a great breakdown of a lot of these numbers. And the insight that I gained from watching their video podcast today was that some of these numbers on the CPI in this index, remember, an index is 12 monthly readings all added up in a row to get up your 3.3% number or your 3% headline number, whether it's core or headline. So the oldest one will come out and it gets replaced by this new one. Some of these next ones that are coming up, like the July of 23 number, the August of 23 number, September, October, these are big numbers. Like the one in January was like a 0.6 from this year, and that's going to stick in that number all year round, which is a great insight that Barry pointed out, which was that an anomaly. But some of these large numbers that are being replaced every month by a lower number, you'll start to see that headline and core number go from 3 and 3.3 to maybe 2.8 and 3.1 down to 2.6 and 2.9 each month. Now that's the CPI. We already see the PCE at 2.6. So that's the Fed's inflation gauge. So this is all very positive news. It's lining up for a Fed rate cut in September. And why do I say September and not July? They want to be safe. As soon as you start this cutting cycle, there's really no turning back. You can raise a quarter, wait a month, raise a quarter, wait for the next meeting. But they start this, the markets will go off and running. And I'll talk about the stock market and how it went off to the races today, just on this report, not even the cut yet. But the Fed's dot plot, the summary of economic projections, it gives the Fed cover for them all to come together and have their meeting behind closed doors and then say to the world, hey, look, now that we've seen this data we've been dependent on, and now that we see deflation on the CPI and coming down and jobs softening, and the SOM rule, shout out to Claudia SOM, SAHM, GDP numbers coming down even lower than expected, growth slowing, labor softening, inflation falling like a rock, they can now get more of a consensus to say, okay, maybe we should cut. If the unemployment rate's at 4.2% by the September meeting, which the September meeting is like September 18th, right? And so we'll get an August jobs report in September. We get a July jobs report in August. If those numbers come down and continue to come down, well then that gives more of some cover for the dot plot to then say, hey, we're going to cut this month in September, and we're going to do 2 or 3 cuts this year. The CME Fed Fund Futures Tool, if you go to that, just a quick look at that, 93% chance of a quarter cut at that September 18th meeting. It's only like a 6 or 7% chance it'll happen in July, but the market is now betting, and that went up from like 60-something% to 93%. So again, we got a lot more data to come out. These things go up, they go down. Keep that same energy no matter what side you think it's going to go on. Doesn't really matter about your energy or the energy of a red dwarf or our sun or any exoplanet. Data is all that matters. Okay, speaking of Fed Chair Powell on a Senate Banking Committee, this is very banky talk right here, but super important. The Basel III Accord, the Basel Accords, where like all these G7, G20, all these great economies get together, and economists and people that know better than we do and know math and think that we should just reserve to the ends of time because we can't have a 2008 financial crisis again. Well, Chair Powell told the Senate Banking Committee this week on Tuesday that he thought that the Basel III endgame, where banks and independent mortgage banks and regulators and everyone in the U.S. is getting all up in arms about having to reserve so much freaking capital. He said, hey, yeah, I think that's not really going to work. I think you guys are going to need to repose the Basel III endgame. And that's what the Mortgage Bankers Association has been lobbying for quite some time. That's a big win. We buy and sell money. Liquidity is huge. Liquidity just went pouring into the market, okay, with inflation coming down and with anticipation of a Fed rate cut. And that means when the Fed, see that bird back there? That's a real bird. It's 7:45 here. We're having sunset here in Corona. Anyway, the Fed, when they cut rates, they are increasing the money supply. They are putting liquidity. The velocity of money in our system is what makes the economy go around. And trust me, there are some people that need it, especially at the lower end. And so lots of great news about inflation and Basel III and all the banky type stuff. Hopefully, you see the 2-year Treasury yield. That is a proxy for where the Fed funds future will be at. If that gets to 4.5 and the Fed funds rate today before the cutting is at 5.25 to 5.50, that's 75 basis points of cuts that the market is pricing in on the short end of the curve. I got a few more minutes here. I want to go over some cool stuff. The U.S. trade deficit has improved monthly. This is from Elliot Eisenberg, the Bowtie economist, from a high of $102 billion in March of 22 to $60 billion in August of 23. But now, by the way, that boosts GDP. Okay, when our trade deficit comes down, that's good for our GDP. We're importing more, exporting less. But now that deficit's been going up, and we're like $75 billion. So the worsening trade deficit reduced the Q1 GDP by 0.65 of a percentage point. So the Q2 impact is likely to be worse. When we see gross domestic product, the growth and health of our economy coming down, part of it is that we're importing more and we're exporting less. So it's something to keep an eye on. Short sellers made $10 billion in the second quarter of 2024. And that's with the stock market going up. By the way, earnings season for Q2 kicked off. Okay, Delta reported today. They reported weak guidance. Their stock went down 30% in one day, some crazy number. The banks come out tomorrow. Banks buy and sell money. They're big partners of all of ours in this business. We need liquidity. So some really big banks are reporting tomorrow. Earnings matter. Earnings are what matter. I am not a financial advisor. I'm not responsible for your losses, only your profits. But take a look at earnings. It's a big deal. It's a fundamental analysis. And so we will start to see earnings, seeing how companies report going into a Fed cutting cycle with the economy slowing. Target will not take checks anymore. I found that very interesting. And Tesla moved back their robo-taxi day from August 8th into October, and their stock went down today 8%. All the Magnificent Seven stocks went down today. Okay. The inflation report that came out made interest rates for mortgages better instantly. It also gets the hype going for the Fed rates to cut, which means money will get cheaper. That really helps small cap stocks. So look at the Russell 2000, the IWM, which is a stock ticker symbol that looks at 2,000 small cap companies. And when money is cheaper for them, for smaller businesses like ours, we have no debt, but if we were to borrow, it's cheaper for us to borrow. So that's good for small caps. And people sold some of their profit, took some profit off of the greatest 7 businesses on the planet, or at least in America for sure, and rotated that money around. Where are they putting that money into? If yields come down on treasuries, dividend stocks are looking a lot more attractive because, they're paying 4 and 5% dividend for a world-class business that has a history and a track record of doing so, when bonds, the U.S. Treasury, will start to pay less. And so this rotation of money, this velocity of money, these are all things to talk about. Okay, the last thing I want to talk about today has to do with some things I'm taking part in. Thank you so much, Rich Stravinsky and Robbie Chrisman. I know Rob was out there on the road, but I was on the big picture today. You can check out the recording online. I also recorded with Dr. Stacy Wayman of NMI. We recorded a diversity, equity, and inclusion podcast for the California Mortgage Bankers Association. Thank you. And tomorrow, Brian View and I will have the last word. the last word of the week. It should be fun. So look out for that every Friday, God willing, with all my travels and craziness. Y'all have a fantastic, wonderful weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.